Back in July, the Fed put a stamp on its 180 policy reversal after it cut rates 25 basis points, introducing the first rate cut since inception of the financial markets of 2008. Coming into 2019, it was a much different picture over at the Fed, with a conversation more about rate hikes and how many would be needed looking out. But threats from abroad to U.S. economic growth, including uncertainty around the impact of U.S. administration trade policy, were what ultimately influenced the central bank to be moving the other way again. The Fed has gone through a major crisis of forward guidance since the 2008 crisis, with its mandate extending well beyond the bounds of the familiar and into the realm of what is arguably quite absurd. But the reality is this: as solid as the U.S. economy may look through the lenses of many U.S. economic indicators, and as much as the recovery in these indicators make a strong argument for policy reversal and a path to normalization, there are still significant holes on even the domestic front that call out for rates to still be at emergency low levels. After all, earnings have barely moved up and inflation remains suspiciously subdued. Interestingly enough, Fed Powell described the latest rate cut as a mid-cycle adjustment, downplaying any ideas that this was reflective of the start to an extended period of rate cuts. And yet, with earnings where they are and inflation where it is, it would seem there is a lot more behind the case for rate cuts than overseas threats and worry about trade policy. Equity market investors have been making this case, and the U.S. administration hasn't been shy, expressing its dissatisfaction with Fed policy that should be a lot more accommodative than a couple of mid-cycle adjustment rate cuts. And so, attention turns to today's Fed Minutes release and any additional color that might come from the event risk. Since the July decision, nothing has really changed on the U.S. front with respect to economic data. The data the Fed has been focused on, which it has used to communicate a message that the U.S. economic recovery is on track, has continued to prove as such. Again, we stress the point that this is the data the Fed has been prioritizing of late, with indicators like wages and inflation not as focused on and much less convincing when it comes to making the case for higher rates. Meanwhile, stress associated with risk abroad has continued, consistent with the Fed's message, which ultimately means there shouldn't be too many surprises in the central bank's communication later today. We expect the minutes will reflect Powell's mid-cycle adjustment outlook, while perhaps further outlining what Powell also made clear at the July presser, which is the fact that mid-cycle adjustments could very well mean more than just one rate cut. The market believes this to be the case, all but pricing in another 25 basis point cut in September. If the language in the minutes makes a point to outline the fact that more rate cuts are to be expected in this period of mid-cycle adjustment, we can expect the U.S. dollar to come under pressure as yield differentials move out of the buck's favor. On the equities front, while the pattern has been one that would argue for higher stocks if such a message is delivered, we continue to argue that this trend has been exhausted over a decade after the crisis, and the idea of racing into stocks on signs of additional accommodation is no longer as attractive as it once was. That's all for now.